All right, moving on. The focus of the market right now is healthcare. That's correct, healthcare, not just pharma. You look at the entire ecosystem is buzzing right now. Hospitals, diagnostics, as well as, of course, uh, the pharma, traditional pharma, generic exporters, all of them are back. So we thought of getting you the most trusted voice as far as healthcare matters are concerned, Aditya Khemka of Incred Healthcare PMS, to chat more about it. And Aditya, thank you very much for your time. Let's start with one stock which has recently held an analyst meet after a very, very long time, and that is RPG Life. In fact, the entire RPG group had an analyst meet day, and I'm told that the attendance and interest level in RPG Life was very good. You must have gathered the commentary as well. You've been tracking it for long. Let's talk about what incremental commentary or visibility has the management given recently.
So thanks for having me. So RPG Life, basically, the company is a very old company in the Indian pharma sector. First of all, from a revenue mix standpoint, a lion's share of their revenue comes from the Indian branded generic business. This is a business that we have historically liked. It's a high ROE, high margin, low capital intensity business. And it's a pull business where the customer actually asks for your brand. Now, what we saw was historically they have not been doing great as a company. There was probably lack of aggression or lack of execution on the management side. But they did a management change sometime in 2017-18. They got a professional manager to come and run the business. And since then, the company has staged a very strong turnaround in terms of their margins, their growth rate, their return on equity, their cash flow. Everything is looking better than the historical numbers. And today, what we understand from the management is that they will continue to do more of the same. They say that there is still a lot of room to improve on margins and the return on equity, and there's a lot of room for them to grow in this market. Remember, they're still a very small company in the context of the Indian pharma market, so there is a lot of room for them to launch new products, increase sales value, increase MR productivity, and therefore increase margins and return on equity and cash flows. So we believe the company is on the right path, and they will continue to do well in the future.
Sure, so that's about RPG Life, but interestingly, you are sort of not very bullish, if I can call it that, on some large cap names like Sun Pharma, Biocon, which is up 5% today, something that you do not recommend at this point in time. What's the rationale?
So see, basically most of these names that you took, they are companies which have many different businesses, including a very large business in the US and European unbranded market. Now, the problem, according to our analysis today in the unbranded markets like Western Europe and US, is that the pricing pressure is immense. So you have too many competitors and you have too few buyers. In European nations, many of these nations do tender businesses where the government procures on behalf of the population. So the pricing becomes very competitive. In the American market today, the North American market, specifically the United States, there are only three large buyers who buy 90-95% of the volumes from the suppliers. And therefore, it's a very tender, competitive pricing war sort of a market, both these markets. And because there is so much competitive pressure, because there is so much pricing pressure, what we are seeing is that structurally these markets seem to be low ROE, low margin, and to add to that, high asset intensity markets, high capex intensity markets. We generally like businesses that generate cash. And what we have seen is the lack of cash generation from Western Europe and US business. Yes, they can give you scale. Yes, they can give you dollar revenues. But does that translate to cash flow? Does that translate to high ROEs? The evidence of that is still not there. It used to be the case in 2010 to 15, but since 2015, we have seen a consistent decline in the profitability and the cash generation ability of these markets, because of which we as investors, we would still like to stay away from that business and wait for data points that can tell us that the business is turning around for good.
Follow up there on Biocon, Aditya. There is a lot of interest in biosimilar, the arm of Biocon, where we saw one big other pharma, major Adar Poonawalla putting in some money, and there is buzz on the street that some more incremental deals could happen there. How do you rate that, and do you see a lot of institutional interest in that part of the business independently, apart from Biocon?
Yeah. So see, the biosimilar business is a very, very interesting business, because it is interesting for us in the emerging market space, where again there is branding, where again there is low capex intensity, and there is patient loyalty, doctor loyalty to the brand. In the unregulated market, in the unbranded market, which is the regulated markets of Western Europe and US again, There, what we are noticing, even in biosimilars, even though they are lesser competitive than, let's say, the small molecule market, but there is price erosion, there is pricing pressure. In fact, in those markets, even the innovator is fighting tooth and nail to retain the market share of their novel biologic, which makes it difficult for biosimilars to go and crack the market in terms of getting market share and volumes. And that challenge seems to be persisting. That has been the case for the past 3-4 years, and we see that challenge persisting. So again, we like biosimilars, but from an emerging market branded opportunity, and we don't like biosimilars in the unbranded regulated market space, which is where we are seeing again a lot of pricing pressure and not so great margins. So again, as investors, we are focused on cash flows. We haven't yet seen the data or the evidence that biosimilars are able to generate the kind of cash flow that could justify the capital investment that goes into making biosimilars.
Okay, so looking at the cash flows and being very, very selective when it comes to the biosimilars. But quickly, Aditya, before we let you go, your word regarding the entire hospital space as well, because I was looking at your recommendation of the stocks at least that you like at this point of time, and they are not the likes of Apollo Hospitals or Narayana Health, etc. They are the bit of the other names, beaten down names, if I can call, or the ones which haven't done, run up that much. What's your rationale with respect to the hospital space?
So look, the hospital space is a great business. I mean, historically, it was not much loved by the investors simply because the CapEx intensity was pretty high. Most of these hospitals used to own the land and building in which the hospital was constructed, so it was CapEx heavy. But over the last few years, the hospitals have shifted to an asset-light model where they essentially lease the land and building and they don't spend on the land and building. So their CapEx has reduced by a good 60-70% because of not owning the land and building rather than leasing it. And that is reflecting in higher cash flows and better quality of balance sheet, lesser debt. The reason why we don't own some of the biggies in the hospital space because of largely valuations. I think valuations are away from our comfort. So our core philosophy remains in picking up a good business at a reasonable valuation. We are not in the camp of buying a good business at any valuation. So because of that, some of the larger names that you said, even though we like the name, we like the operating model, the valuation sort of keep us away. The stocks that we own are good business models within the hospital space, but are also reasonably valued, which is why we own those stocks.
Yeah, it appears that the tide seems to be turning for this group of stocks. Hospitals and diagnostic were already doing okay, but pharma is coming back. Ownership is low. Pricing pressure in US seem to be ebbing. If one were to take this is happening after 3-4 years, right? Gap. If one were to take a next 2 to 3 year kind of a view, where do you see highest amount of risk reward at being attractive, and things can turn up that the alpha could be very big? Any particular names?
So in the current market environment, we think branded generics and diagnostics. So diagnostics, even though they have done well from a 10-year horizon, but if you look at the last 2-3 years, diagnostics actually as stocks have not done that well. And the reason for that being that investors believe that post-COVID, because there are online discounted platforms in diagnostics, the traditional brick and mortar businesses will probably be disrupted. But the data that has come out of these companies over the past 3-4 quarters since the launch of these online discounted platforms did not give any evidence of a disruption. In fact, these companies are growing pretty well with healthy margins. So I think the risk reward is extremely favorable in terms of diagnostics. In branded generics, basically last 2-3 years were not good because the raw material cost from China went up. Remember, the Chinese production was not up to par during the COVID period because China had a complete lockdown policy, a zero COVID policy as they used to call it. And now that policy doesn't exist anymore. So because China was producing lesser raw material, the prices of raw material shot up. And now that China has removed the zero COVID policy, the prices of raw materials are coming down. And branded generics every year take up nominal price increase on their portfolio. They have been doing that for the past 2 years also, but past 2 years, the raw material price inflation was higher than the price increase of the product. So the margins were still compressing even for the branded generic guys. This year and for the next 2-3 years, we believe in branded generics, the prices of end products will go up and the raw material prices will actually come down, which will open up your margins, and the margins will probably get restored to what they used to be historically. And therefore, there is a very favorable risk reward in that bucket as well. Diagnostics, we just believe that the business is growing as normal, whereas stocks and valuations have been depressed to a very large extent in the fear of a disruption from online platforms, which no data is basically supporting that kind of a skepticism.
Aditya, we know you like Thyrocare and Krishna Diagnostics from the diagnostic space, but from the branded generic market, could you talk to us about some of the top bets?
So some of the top bets that we hold in our fund in the branded generic space are RPG Life, Thyrocare, RPG Life, Torrent Pharma, Alchem. We own JV Chemicals. So these are some of the stocks in the branded generic space that we like.
Okay, Aditya, on that note, we'll let you go. Really appreciate you making time and speaking with us. But from